There are a lot of misconceptions about fund of funds, how they're built, how they're put together, how two fee structures works, what's the compliance around this and how to build one, what's the difference between a fund of fund and SPVs, what's the difference between a fund of fund and other structures that just, I don't know, feed into a fund that you're gonna raise for and help build. So that's what we're gonna talk about today in this video. So let me first set the groundwork of what fund of funds are in a traditional sense. Then we'll talk about some of these SPVs and other feeder funds that people have been building on YouTube and talking about these kind of a little bit wonky structures, but we'll dive into it. So in the most basic sense, fund of funds, you have a fund. Okay, here's a fund. This fund has a GP, LP structure. This fund is gonna go buy, let's just say real estate. So here we are, fund is buying real estate, boom, we drew this thing out. So we have 3 real estate properties this fund is gonna buy down here. This is the actual fund. This fund is gonna raise $100 million. Boom, bada bing. So what a fund of funds says is, hey, well, you can invest in this fund directly as a limited partner, an LP, but what if we built a fund, another fund over here that invests into this fund, hence a fund of funds. So someone else, I'm gonna put this in blue, let's say me and you got together and said, let's do a fund of funds. We're gonna build a fund over here. Here's our fund. I'm gonna put fund. We got our GP and our LP structure. We're gonna have a fund that invests into this fund as well as other funds. So the idea of a fund of funds is this fund does real estate. Great. We also wanna do another fund over here that does venture capital. And we also wanna invest into another fund over here that does let's do private equity. So our fund here is gonna raise maybe $1 billion. And our fund of funds is we're gonna look at managers, we're gonna evaluate these managers, and we will write a check into here for 50 million. And we're gonna write a check over here for 200 million. And we're gonna write a check over here for, I don't know, I'm just giving round numbers, 150 million. And then when these funds have returns, the money flows back to our fund like this. And we get a return and then we flow that money back to our investors up here that are LPs that raised the $1 billion with us. Okay, hopefully this is making sense on a basic level. So now let's go to the next layer here of like, well, why would you do this, Bridger? Investors are smart, like we have investors for this $1 billion. Why would they hire us here? Because we're gonna take some fees. You know, there's gonna be a little fee here. And then also these managers are charging fees. So a smart investor is gonna say, well, Bridger, what if I just went directly into this fund? Why would I come through a fund of funds here? So let's talk about that. I'm gonna go to the next page. We're also gonna talk about different feeder fund structures and SPVs on how this works on smaller funds and bigger funds. We're talking about the traditional sense here. All right, I drew this out a little bit prettier so y'all can see, okay? So we got our fund up here, $1 billion raise. We got real estate, venture capital, private equity. How does this fund of funds actually make money? And an investor would want to invest into a fund of funds rather than going directly to these individual private funds. There's a couple reasons why, and I'll list them up here. So number one, they get diversification, okay? They get diversified amongst a real estate fund, a venture capital fund, and a private equity fund. Now, additionally, that's the first one, a fund that's big. The next one, they can actually negotiate fees. So, for example, let's use this one, real estate or venture capital fund. This VC fund, if you came in directly, is gonna charge you a 2 and 20, a 2% management fee, 80-20 split. If you don't know what that means, we have other videos that talk about this, okay? But a fund of funds will say, hey, well, venture capital firm, we're gonna write you a $75 million check. But we don't wanna pay 2% management fees. We wanna pay 1.25% management fees. And we don't wanna pay 80-20 split, we wanna pay 85, I don't know, 15 split. And this venture capital firm might take that offer because that's a big check in regards, maybe they're only raising 300 million or 400 million, that's a big chunk of their fund. Yeah, you know what? We're gonna lower our management fee for you and we're gonna do a little bit better of a split for you, okay? So again, we get better fees and splits and here, and then as far as fees go, the fund of funds up here wants to make money. And so they're gonna charge a lot of times the difference. So they'll say, hey, we charge a 0.5% management fee and maybe we charge 5% carry. Because what's happening here is an investor that comes into a fund of funds is getting double feed. They are getting feed here on the fund of funds level, and they're also getting feed here at the venture capital level. It's 2 layers of fees. Because of that, the next tier I'm gonna put here is on compliance. There is a lot more compliance that happens when you do a fund of funds. Because you're charging not 1 fee, you're charging now 2 fees. 0.5 up here and 1.25 down here. We lost part of the marker. We're gonna keep rolling though, okay? So the compliance goes up. Oftentimes you need more compliance and oftentimes licenses to do this. It depends on what state you're in and how large your fund of funds is. But again, I'm sharing on a larger sense. But again, as an investor into a fund of funds, you get a diversified portfolio. Oftentimes you do get lowered management fees if they negotiate well. There is increased compliance here, which actually helps, and they're gonna now vet these fund managers more. The third one is minimum commitments. Many funds you cannot even get into. There are certain rules, we have other videos on this, where the SEC limits funds to 99 or 1,999 investors. For example, you guys know Mr. Ray Dalio, right? Ray Dalio, I believe, stopped raising money in 2005. They literally turned investors away. To get in that fund, you had to have a $100 million minimum commitment and had to have a $4 billion net worth to even talk to them to get into his funds. Same things with Jim Simons, who just passed away, but Jim Simons had a similar thing, and then they closed their fund. Why would they do that? It's because the SEC, under a 3C7 rule, you can only raise from 1,999 investors. So it's very exclusive. There are many funds that maybe me, Bridger, I would love to get into this private equity fund, but the minimum is $20 million. And at least as of today, I don't have 20 million to just plow into one investment. So what I'm gonna do is I'm gonna write a check into a fund of funds, and maybe I'll put in 500,000. But the fund of funds combined is gonna write a check of more than 20 million and get me into that very exclusive private equity fund. See how that could make sense for a fund of funds? That's where the market of fund of funds comes from for here. Now, Bridger, let's talk about a few of these other nuances with SPVs, people doing fund of funds for very small funds. How does this make sense? But I mentioned this on a large scale because traditionally, fund of funds only really makes sense when you're raising a lot of capital. It doesn't make sense to do a fund of funds for $300,000 or $500,000 or $1 million or $5 million. It's like they're usually 300 million, $1 billion, $5 billion, because when you have more money in the fund of funds, you can leverage diversification fees and minimum commitments a lot more than with small funds. With small funds, people can just go direct. But on that note, let's open up a new piece of paper. So there's a lot of people on YouTube online talking about, hey, build a fund of funds and invest into my fund or partner with what we're doing. What I would share is the vernacular of fund of funds I don't think fits. Fund of funds is actually a definition from the SEC. The SEC has a definition for fund of funds. It's all the stuff I just previously talked about. What people online are talking about is more something like an SPV, a special purpose vehicle, or sometimes you hear SPE, special purpose entity. All this means is a fancy language of saying like an entity, like an LLC, that's for a special reason, okay? The special reason is to invest into a certain asset or vehicle. So for example, there's been some fund managers that run a fund like this. So they have their GP, they've got their fund here, and they are raising capital. So they got investors coming in like this. These are their investors. And what they're saying to other people is, hey, go set up an SPV over here. And what we want you to do is, let's call it right here, set up an SPV, and you go raise money from a handful of people, and they'll all flow in to your SPV, and then your SPV will invest in the fund. And they're calling that a fund of funds, which again, you can use that vernacular if you'd like, but the SEC again calls this thing so I would call that just a special purpose vehicle or entity. Now, a few things to consider when thinking about doing this, okay, is number one, the SEC is smart. Oftentimes, they will ask the question on any of your compliance docs, is this investor, they ask, is it a special purpose vehicle? And is the only purpose of this vehicle to pool investors together to invest into this fund? And if you answer yes to that, they have a look-through clause, and they go look through and they want to make sure each one of those investors are the right type of investor. Now, why would this ever happen is because most funds can only take capital from accredited investors or higher, sometimes qualified clients or qualified purchasers. We've got other videos that talk about the differences of those, but an accredited investor is essentially a millionaire. You have a $1.1 million net worth or $200,000 a year, or you make $300,000 a year with your spouse, you're an accredited investor. For example, my fund, we only can take accredited investors. So an entity, if you said, hey, we're gonna get 10 people together and we're all non-accredited investors, we're gonna put money together and then we will have enough money to get into this fund, we say, great, but is the purpose of this entity the only reason this entity to invest in the fund? If it is, sorry. The SEC has a look-through clause, and they will look back to you through that SPV, and oftentimes you can't do it. Now, if the SPV, though, has other purposes, this SPV also invests into other funds that are down here. Well, great. Yeah, we can take that money, because now it's acting more like a fund of funds, because it has multiple purposes and multiple vehicles. But again, if you're gonna run a fund of funds, back to our last page, your level of compliance goes way up. You probably have to have a license to do that, most likely a Series 65, and you have to do a lot of disclosure to these investors to make sure they know they're getting double fees. They're getting feed from you, because you're not doing this for free probably. You're gonna probably set this up and charge whatever fee you want here. And then the fund is also charging fees as well. Now, another structure I've seen, okay? People are creative. You guys are creative out here, okay? Another structure I've seen is this. We've got the fund here. This is the core fund that someone is doing. And this is, I'm gonna put fund. And they'll say, hey, instead of doing an SPV to get into this fund, this fund is gonna go buy assets down here. We're gonna buy real estate, homes, or whatever we're doing. What we want you to do is we're gonna set up a fund with you. This fund is a new fund and you're gonna be a manager with us. So we're gonna be setting up a new GP. You're gonna take, 20% of this. We're gonna take 80%. And this is a new GP. We're gonna set up a fund with you. My team will help set this fund up with you. And we're gonna also invest into the same assets and co-sponsor these assets with you. And we're gonna do this with seemingly endless numbers of people, right? So this person's gonna be 20 and 20 and 80, 20, and we're gonna all co-invest into these same assets. And this core team of G, we got like maybe 10 people over here. This core team is gonna help manage all these things, and all you need to do is just raise capital. So you raise capital here and here and here, and when you raise that capital, you then partner with us as a GP, and then we flow into the same pool of assets, and we're gonna be buying them together. And that's how we're gonna take down a lot of this structure. Now this, Bridger would not call this a fund of funds, okay? Like I wouldn't use that vernacular, because in the SEC vernacular, they want you to do different things. This would be more of what I would just call SPVs, or fund management as a service, okay? There's groups that'll say, hey, we'll help manage and run your fund as a service. You just bring us investors, right? Bring us that 20% and we'll invest in the same assets. Now, one last nuance I'll add here. This, in my sense, go talk to a lawyer, I believe is very legal as long as each one of these funds, as you progress over time, is investing into different assets. So this works well in a real estate opportunity, maybe even private equity or venture capital. If you're doing a trading algorithm though, or you're doing something along the lines of a hedge fund, this won't work as well, because the SEC again is smart, and what they deem it as is, hey, this is just a fancy way to get around some laws to invest in the exact same trading strategy and get around our rule of 1,999 investors. And so if you're getting around that clause, we're not gonna do that. So trading, they crack down on this more. With real estate and private equity, it's usually not as bad, and they're generally okay with this. Again, I talk to a legal team, make sure it's good in your state and your location that you are in.